We did a video on this channel not long ago about the concept of buffers and downside protection, what a buffer is, how it behaves in different market conditions, and why defining your risk before uncertainty arrives changes the experience of being invested. Today, we are going specifically into buffered UITs, how they are structured, what the real numbers look like, and what you need to understand before you consider one. Before we get started, what you're seeing is an AI-generated avatar of me, John Wiswell. The ideas, the research, the perspective, all real. We just think this is a great way to bring it to you. If you caught Blake's earlier video on stock wrappers, you already understand the basic framework. The portfolio is assembled at the start, it runs for a set period, and at the end of the term, the outcome is calculated based on how the underlying index performed. Most buffered UITs are structured with terms of either 15 or 24 months. That defined timeline matters, and it is one of the most important things to understand before investing in one of these products. The buffer protection is designed to work at maturity. If you need to exit early, the issuer may repurchase the UIT at its current net asset value, which could be significantly lower than what you paid, depending on where the market is at that point. Buffered UITs are not designed for investors who may need their capital before the term ends, even though the investment is liquid. They are designed for investors who can commit to holding through maturity and allow the structure to do what it was built to do. Now let's talk about the buffer levels, because this is where the real decision making happens. I pulled these numbers from current products that are available at the time I put this video together. These are typically available with 10%, 20%, or 30% buffer levels. Each absorbs a different amount of market loss before your capital is affected, and each comes with a different cap on the upside. The more protection you want on the downside, the more you give up on the upside during a strong market. Thoughtful. At the time I put this video together, 15-month buffered UITs linked to the QQQ were offering roughly a 24% cap with a 10% buffer, around a 15% cap with a 20% buffer, and roughly a 12% cap with a 30% buffer. On comparable S&P 500-based UITs, the numbers were roughly 16.5% with a 10% buffer, around 11.5% with a 20% buffer, and about 8.5% with a 30% buffer. These numbers change over time based on market conditions and interest rates, but they give you a real sense of what the trade-off actually looks like. It is also important to be clear about what the buffer does not do. A buffered UIT does not provide full principal protection. It is not FDIC insured. If the underlying index declines more than the buffer amount, you will experience losses on the portion beyond the buffer. A 10% buffer in a market that falls 30% still leaves you exposed to 20% of that decline. The buffer reduces risk. It does not eliminate it. Now let's look at why that protection still matters so much in practice. Imagine two investors, both starting with $100,000. The first is invested directly in the S&P 500. The second is in a buffered UIT with a 20% buffer. The market falls 20%. The first investor drops from 100,000 to 80,000. The second investor's buffer absorbs the entire decline. Their account stays at 100,000. The market then rebounds 10%. The first investor grows from 80,000 to 88,000, still 12,000 below where they started, despite a solid recovery year. The second investor starts that same recovery at 100,000 and ends at 110,000. A $22,000 difference, not from a better market, but from avoiding the loss in the first place. A portfolio that loses 20% needs a 25% gain just to break even. That drag is what buffered UITs are specifically designed to reduce. I like to think of this as a built-in dollar cost averaging tool. When the market goes down, you are credited dollars back that allow you to reinvest at a lower market price. A 10% buffer suits an investor who wants meaningful growth potential with a modest layer of protection, comfortable with some market movement, but wanting a cushion against moderate declines. A 20% buffer speaks to someone more cautious who wants a larger portion of market losses absorbed before they affect the portfolio. A 30% buffer is for the investor whose main concern is protecting against significant downturns, willing to accept lower upside in exchange for greater confidence during volatile markets. The right buffer level should reflect an honest assessment of your timeline, your temperament, and how much capital you can afford to put at risk. What ties all of this together is the idea we keep returning to on this channel. A buffered UIT gives the option to take part in the market while establishing protection before uncertainty arrives with an outcome you understood from day one. We still have structured notes and buffered ETFs ahead in this series. Each one carries the buffer concept differently and serves a different purpose. But the reinvestment dynamic we covered today is specific to the UIT structure, and it is one of the most underappreciated features in all of structured investing. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.